Hey everyone, this is Michael, and this is the Market Trend Advisory weekly video for April 1st, 2022. Before we start, this is our disclaimer. You can pause the video and read this. So let's go ahead and get started. So the market for the indexes is it still continues to be quite bullish. Of course, we're in a market in uptrend. The uptrend's been strengthening. We are on an index action signal of hold for both indexes just because we sort of hit a stalling point a few days ago, and individual stocks really haven't been acting all that well. But anyways, all in all, we put that on hold. For individual stocks and non-index ETFs, we've reduced our exposure down to 25% from, I think it was 50%. Maybe that was in our stock picks. I know we came down at least from 35%. I'd have to look at the chart. But they just haven't been acting all that well. So it's a little bit of a red flag there. But for the indexes themselves, we're looking pretty strong. But yeah, for the individual stocks, we're just getting a lot more breakout failures, a lot of volatility. Stocks that break out and then plunge 10%. There's been some, even you see that sometimes in the more speculative stocks, but we saw that like in J.B. Hunt, a big trucking company, had a huge plunge on Friday. So these are things that shouldn't be happening, but they are. So it's a sign of a not as healthy market as we would like. So that's where we are with that. The market count is 5 out of 5 for the Nasdaq, 100% exposure, and we have no institutional selling days, which is pretty remarkable. And our power trend is off. And again, the power trend is sort of a special situation. The market, the price is usually, well, not usually, it's always set up over we're a number of days above the 21-day and above the 50-day, and the 50-day has to be an uptrend. There's some other rules that go on there. But when we hit that, the market is allowed to go up to 7 and gives us a little bit of a buffer. So when the market really starts taking off and then we get a few sell signals, you're not being forced to sell out if you're following our strategies. And for the S&P, it's all the same except that we did have one more buy signal on Friday for the market count. So it now rises to 5, and we're now at 100% exposure too. And we do have one institutional selling day, but super low considering the run that it's had, and the power trend is off. So we'll take a little quick look here. This is the Nasdaq. We had our follow through over here, and we had pretty much a straight up run, really powerful. The big question is a lot of debate: is the bottom in? Sometimes when you see this kind of really strong action day after day, opening at the lows, closing at the highs. You see this a lot more in bear markets than you do in bull markets, and but we did blast right past this 50-day, which is now starting to turn up. We didn't even in Nasdaq we haven't quite hit the 200-day, so we don't know. It's sort of near resistance. So this is just one of those things we don't know. It's hard to tell what's going to happen. You do see these big moves in bear markets. We were in a bear market. So we're going to leave that up to let the market tell us what it's going to do instead of just trying to guess. Looks like we were going to have another down day in both indexes on Friday, but last 20 minutes, just the buyers came piling in as they like to do and sent it up. And so we had actually we had another buy signal here too. One of the things we look at is the number of days above the 21-day moving average, and those gives us quite a lot of our market count buy and sell signals. So this one today over here, we actually, Friday, gave us a living above the 21-day. So we have low above the 21, trending above is 5 days after that, and then we have living above and those are all buy signals. And then conversely, if we're breaking below the 21, like we had here, we sort of had our first day, I think it was probably this day here was, break below the 21-day or low below the 21-day, then continued down. This was living below, and then we had or trending below, then living below, and then of course we came back up. So we didn't need this buy signals here just because we already had 5 out of 5. and so we're at maximum. So we've had quite a few over here, I think, that didn't really, so it's really showing a lot of power into the surface in terms of our system, that I think we've had either 3 or 4, buy signals that we couldn't really use because we're already maxed out. So for the S&P, same thing. Here was our day at the low above the 21. Then we had living above the 21, and then we don't count any of the days until they are up days. So I think it was going to actually be on this day, but since these two were down days, we didn't count it. Now here we are. So we had another buy signal that gives us at 5 out of 5. So now S&P's acting a little stronger. It's above both its 50-day and 200 and 21-day. And they're not quite lined up again as we see when we're in a nice, bull trend. So, but it looks like we're getting there. This is starting to come up. Looks likely this is going to try to make a new high, but of course anything can happen. Didn't go into a bear market. We didn't quite get there. So it's acting stronger than Nasdaq. Just take a look there. We're just Nasdaq just went down farther, but we had much more of a bear market in many of the stocks. So we'll see what happens with this. For our investing strategies, we have no change for the QQQ, or the QLD or the TQQQ. We're still at 100%. We've improved quite a bit. In fact, a few days ago, before we had the corrections, we were almost flat on our two things come from down. I think we were down 13 or 12, and this was almost down 18 at one point. So we came back like 15 points, 15%. It's pretty good, but we've kind of come back down. So the SPY, on Monday morning, following the system, you would be moving your exposure in the SSO. That's the 2 times the SPY ETF. You'll move from 90% to 100. And there's our current return. So, and then we also we put in an optional stop loss, only because we don't like to really mess with the system, but because we had this massive move, the next time we would get any sell signals was quite a ways down. So in other words, you have to either be breaking below the 21, which was, like 500 points below, or the 50, which is even lower, and there's no institutional selling days, so we'd have to get at least 5 of them to start giving us some sell signals to knock the market count down. So we just put this in as a little bit of a protector that you don't just start giving up all these gains and not have any kind of a way to lose them. Normally we don't do that. We have a much tighter, move up, and we just leave it alone because we're just, closer to the moving averages and the other indicators that will trigger the market count buys and sells. So that's that. I'd say really the last thing I just want to go over to, it's kind of the newest worry for the market. I'd say so far, the market has been discounting basically virtually everything that's been thrown in its path. The Russia-Ukraine conflict, that seems to be accepted and move on. So, inflation, that's been, of course, for many months now, market seems to be brushing it off as not really an issue, which is, all these are just sometimes difficult to understand intellectually. Market has its own way of looking at things, and it's always looking out and discounting the future in what's happening in the future in the current day. So that's something. It's the rising oil prices. It seems to have accepted that. But the latest one is the inverted yield curve. And what that just means is that you have shorter dated bonds are now yielding higher than the longer ones. Normally it's the other way around. So for example, on Friday, basically we were at 2.38 on the 10-year, but we were at 2.44, call it 2.45 on the 2-year. And then we're also starting to see the 5-year is now above the 30-year. And that is inverted for the first time since 2006. That happened this week. So these are concerns because the market doesn't want to see this go on for a long time, because it's one of the indicators of recession. Now, it doesn't guarantee a recession, but it's something that has pretty much always happened before we have had a recession. Now, also the one thing is that people say, "Oh, it's reverted. That's it. It's all over." But it can take 6 months to more than a year after we first see the yield curve invert before there's any kind of economic downturn. So there's always a little bit of a lag there. But I think the key thing to look for is that when if we stay inverted for an extended period of time, that has been called, quote unquote, strikingly accurate as an indicator, as some of the researchers at the San Francisco Fed wrote a few years ago. So that's something the market is not going to like. And I think that's caused some of the volatility and the down days we had this week, is that we started seeing first, I think it was the 2-year and the 10 inverted. Then I think they went back to flat, then they inverted, and now we're starting to see the 5 and the 30. We start seeing more and more of this, or it gets farther and farther apart. The market is not going to like that in conjunction with everything else going on. So we're going to be sort of watching that as another issue of what's to look for in this market. So I'd say overall, of course, we also have worries. The market's been, as we talked about last week, climbing a wall of worry. This is just another step on that wall that market's going to have to try to hurdle over. If there's too many hurdles, sometimes it stumbles and falls back down, and sometimes breaks or just bounces and comes right back. So we'll see. But and again, going back to the indexes, we look pretty strong. The individual stocks are not acting that well, so we have a little bit of a conflict going on between those two. But say overall, we just continue to watch what's happening. You should have some exposure to this market. If you're following our system, you're at 100%. Stocks, you should have far less than that. And we'll be back next week to continue the saga of the market. Okay. All right. Thanks. Bye.